Okay, so you want to be a market maker. No forecasting, no betting on whether a stock goes up or down, no macro calls, no reading earnings reports at midnight. You just sit in the middle of every trade, quote a price to buy and a price to sell, and pocket the tiny gap between them, over and over, millions of times a day. No opinion required. Just be the person standing between every buyer and every seller in the market, all day, every day. It sounds like the closest thing to a money printer that Wall Street has ever legally built. And the numbers back that impression up. Citadel Securities, the largest market maker in the United States, pulled in $12.2 billion in trading revenue in 2025 alone, with $4.3 billion of that landing in a single quarter. The firm now handles somewhere around 35% of all U.S. retail equity volume, and it's the designated market maker for roughly 62% of every listing on the New York Stock Exchange. That's not a company making a few smart bets. That's a company sitting inside more than a third of every retail trade that happens in the largest stock market on Earth. Here's the number that really breaks people's brains, though. From 2009 to 2014, the high-frequency market maker Virtu Financial lost money on exactly one trading day. 1 out of 1,238 trading days. That's not a hot streak. That's a business model that has functionally never lost. So here's the problem. If it's that reliable, why isn't everyone doing it? The answer is that the profit on any single trade is almost invisible. A market maker isn't charging you a markup the way a store marks up a can of soup. They're capturing a spread that's often a fraction of a single cent on a stock that might trade for $50, $100, for $100 a share. Roughly half of Virtu's individual trades actually lose money. Their own CEO admitted it. About 51 to 52% of trades are profitable. That's barely better than a coin flip on any individual transaction. The entire business isn't built on being right. It's built on doing that coin flip a few million times a day and letting the law of large numbers do the rest. So throw out the mental model you walked in with. This isn't a trading business, and it isn't gambling either. It's an insurance business dressed up as a trading desk. You are not betting on where the market goes. You are getting paid, constantly, in tiny increments, to be the counterparty standing ready whenever someone else needs to trade right now. The risk you're insuring against isn't price direction. It's the risk of being the last one to find out something the rest of the market already knows. Let's talk about what it actually costs to sit in that seat. There is no small business version of this. You cannot start a market-making operation out of a garage because the entire product you're selling is speed and certainty, and both of those are extraordinarily expensive to buy. First, you need a broker-dealer registration and membership with FINRA, which alone involves a lengthy approval process and minimum net capital requirements set by the SEC's net capital rule. Capital you have to keep parked and in use just to prove you can absorb a bad day. For a serious equities market maker, that regulatory capital cushion typically starts in the tens of millions of dollars and climbs from there, depending on how many symbols and how much volume you intend to quote. Second, infrastructure. To compete, you need colocation, physically renting rack space inside the same data centers as the exchanges themselves, because being even a few hundred feet farther away than your competitor means your quotes arrive microseconds later. And in this business, microseconds are the entire game. Colocation and direct market data feeds from every exchange you trade on can run into the millions of dollars a year before you've executed a single trade. Then there's the technology build itself, the actual trading engine, the risk management system, the order routing logic. Building a competitive low-latency trading system from scratch is routinely a multi-year, multi-million-dollar engineering project, which is exactly why most of the firms that dominate this industry were built by teams of physicists and engineers, not stockbrokers. Third, talent. A market maker isn't hiring cashiers. It's hiring quantitative researchers, low-latency C++ engineers, and risk managers, and that talent is some of the most expensive labor on the planet. Virtu ran its entire multi-billion-dollar trading operation with only 148 employees at one point, and that's not an accident. It's the whole point. Every one of those employees has to be worth an enormous multiple of a normal salary, because the firm is competing on raw technical superiority, not headcount. Now let's talk about what it costs to keep the lights on once you're actually running. Exchange fees are a constant, grinding cost. Every exchange runs on a maker-taker model, paying you a small rebate for posting liquidity and charging you a small fee for taking it. And a huge amount of market-making strategy is built entirely around capturing that spread between the rebate you earn and the fee you avoid. Data feeds from every exchange, every dark pool, every alternative trading system you touch, all carry ongoing subscription costs that scale with how broad your market coverage is. Compliance and regulatory reporting is its own department, because you are one of the most closely watched participants in the market, and a single control failure can trigger an SEC investigation. And then there's the cost of capital itself. Every dollar sitting in your trading book as a capital cushion is a dollar not earning a return anywhere else. And that opportunity cost is real even when your trading strategy is flawless. And here's the leak that doesn't show up on any invoice: adverse selection. This is the single most dangerous force in the entire business. When you post a price to buy and a price to sell, you have no idea who's on the other side of that trade. Most of the time, it's an ordinary retail order, uninformed, and you capture your spread cleanly. But sometimes it's a trader who knows something you don't, a hedge fund about to dump a massive position, a piece of news about to break, an algorithm that's detected a pattern faster than yours has. When that happens, you don't just fail to earn your tiny spread. You get run over. You bought right before the price collapsed, or sold right before it spiked, and one toxic trade can erase the profit from thousands of clean ones. The entire art of market making isn't setting a price. It's constantly, in real time, adjusting how much you trust the person on the other side of your quote. So how does the profit actually get made, given all that risk sitting underneath it? Two engines. First, the spread itself, buying at the bid and selling at the offer, captured over enormous volume. Second, payment for order flow. Retail brokers like Robinhood route their customers' orders to wholesale market makers like Citadel Securities, and in exchange, the market maker pays the broker for the right to fill those orders. Across the industry, market makers now pay more than $4.9 billion a year just to buy access to retail order flow, because retail orders are, on average, less informed than institutional orders. They are the cleanest, least toxic flow in the entire market, which makes them the most profitable flow to trade against. That's the real business model. Get as much uninformed volume as possible, price it fast and fairly enough to stay compliant, and let the spread do its work across millions of tiny transactions a day. And underneath that, there's a set of tricks that separate the dominant firms from everyone else. Speed itself is a weapon, being close enough to the exchange and fast enough through the wire to update your quote before a stale price gets picked off by someone faster than you. Internalization lets a firm match its own buyers and sellers off exchange before the order ever touches a public market, keeping the entire spread in-house instead of splitting it with an exchange. Tiered rebate programs reward the market makers providing the deepest, most consistent liquidity with better pricing than smaller competitors get, which is exactly why scale compounds in this business instead of leveling out. Now for the part that makes this whole industry genuinely dangerous. Unlike a grocery store, where a bad quarter shows up slowly over months, a market maker's costs and risks are compressed into microseconds, and that means catastrophic failure can happen almost instantly. Take a volatility spike. A sudden VIX surge can either be enormously profitable because spreads widen and volume explodes, or it can be lethal if your risk models can't reprice fast enough to keep up with a market that's moving faster than your own quotes. Take a software error. In an industry where algorithms execute millions of trades a day with no human in the loop, a single bad deployment can turn a fully automated, perfectly rational trading system into an uncontrollable liability before anyone even notices something is wrong. Take regulatory change. Payment for order flow has been publicly scrutinized by regulators for years, and a rule change banning or restructuring it would strike directly at one of the two main profit engines of the entire industry overnight. Take competition. As more firms buy the same speed and the same infrastructure, spreads compress towards zero, and the exact same technological arms race that built this industry's fortunes is also the thing slowly grinding its margins down. The competitive landscape reflects exactly how brutal that arms race has become. Citadel Securities sits at the top with roughly 35% of retail volume. Virtu holds the number 2 position in retail wholesaling. Jane Street and Hudson River Trading, both firms that built their edge in institutional markets first, have muscled into the retail channel and now handle around 10% and 20% of overall U.S. cash equities volume respectively. Susquehanna, once a top 3 player, has slipped to 5th as competitors with newer technology outgrew it. This is not an industry where an independent operator can quietly carve out a regional niche. Scale, speed, and capital efficiency are the entire game, and falling behind on any one of them is fatal. Which brings us to Knight Capital. On August 1st, 2012, Knight was one of the largest and most respected market makers in the United States, 17 years of history, a trusted name on Wall Street. That morning, a technician deployed new trading software to the firm's servers, but only 7 of the 8 production machines received the update. The 8th still contained a piece of dormant test code from 2003, a feature called PowerPeg, and when live orders hit that server, it woke up and started trading. For 45 minutes, Knight's systems flooded the market with unintended orders across 154 stocks, executing more than 4 million trades covering roughly 397 million shares, buying high and selling low in a pattern that made no economic sense and that no human could shut off fast enough. By the time the system was finally killed, Knight had lost $440 million, roughly 3 times the company's quarterly revenue, in less time than it takes to watch a football game. Its stock lost 75% of its value within 2 days. The firm survived only because Goldman Sachs agreed to take the entire toxic position off its books overnight, and Knight was acquired by a competitor within months. 17 years of institutional trust erased in 45 minutes by one line of dormant code on 1 out of 8 servers. Compare that to Virtu, sitting a few miles away, engineering its systems specifically so that no single point of failure could ever do to them what PowerPeg did tonight. Same industry, same razor-thin margins, same reliance on machines moving faster than any human can watch. One firm built the discipline to survive that. One firm didn't. So what does the real math look like if you're the one building this business? In the good scenario, you've built genuinely superior technology. Your risk controls catch anomalies in milliseconds instead of minutes. Your retail order flow relationships are strong, and your capital base lets you quote deep, consistent liquidity across thousands of names. In a year like that, you're compounding a tiny edge across billions of dollars of volume, and the payoff looks like Citadel's $12 billion, or Virtu's multi-year streak of not losing a single day. In the realistic scenario, spreads keep compressing as competitors by the same speed you did. A regulatory shift chips away at payment for order flow. A volatility spike outruns your risk model for just a few minutes, or a deployment error slips through the one server nobody double-checked. And in this business, unlike almost any other, a few minutes is all it takes to turn 17 years of profit into a bankruptcy filing. That's the real secret behind the market-making business. It looks like a business about capturing a spread. It's actually a business about surviving the one moment your speed isn't fast enough.